creative strategies for an irrational market. I decided to title this video that because traders don't want to go long this market due to the tremendous downside risk. Simultaneously, they don't want to short this market because of this robust upside momentum. And traditional option strategies don't work in this market due to extremely elevated implied volatility. And so you have to be creative with the strategies you use. And that's why today we're going to be going over what these creative strategies are and when to implement them. Before I go on with this video though, I want to let you know that I am going to try and sell you on something. Now before you click off this video, I guarantee whether you buy the service or not, you will learn something new. With that said, let's get into the video.
The first strategy I want to go over is the butterfly spread. Now, if you're on QQQ, and we trade QQQ quite a bit, you can see I have a chart open right here for QQQ. If you're trading QQQ, sure, you could have just bought 100 shares, but that would be extremely risky, and you would have a bunch of downside risk, and even if you place a stop loss, you would have gotten whipsawed out of that stop loss, right? Overall, it's capital inefficient, and it's really risky. And buying calls and call spreads, the problem with that is that because volatility is so high, they're so expensive. And because they're so expensive, they have a lot of time decay. So we don't want to do that either. And so the alternative is a butterfly spread. And a butterfly spread, we actually make money from the passage of time. And on top of that, in a butterfly spread, we're actually able to make a directional bet too for a really cheap amount. In fact, we were able to put on a butterfly spread for a debit of $36 for 1 unit and just 2.5% of our portfolio, risking a real small amount on the trade, paying $36 for it, and we were able to take it off in less than 3 days for a 150% profit. And on top of that, many people got filled for a better price because I did say if we get a pullback in the NASDAQ over the next $2, 2 hours, you could easily get filled for less. And that's exactly what happened. So let's actually take a look at what a butterfly spread is, though. So a butterfly spread is pretty simple. Now, in a call option, you just buy one of the call options, and in a call spread, you buy one call option, sell another call option. Well, in a butterfly spread, you buy one, you sell two, and then you buy one. And this structure makes it so that it is extremely cheap to put this spread on. The reason it is extremely cheap to put this spread on is because of these two options that you're selling right here. If not, this spread right here, or this trade right here, would essentially be, I would say, 50 times more expensive to put on. So the reason that we put this on is because it's extremely cheap. So let's say QQQ is at $290, and it's going up, and you're asking yourself, how can I participate in this rally on the way up? I don't want to buy QQQ. Calls are too expensive. Call spreads are too expensive. You're going to do sort of a butterfly spread. You're going to go ahead, and you're going to buy the 295 call. And excuse me for my bad handwriting right there. You're going to sell 2 of the 300 calls. And then you're going to go ahead and you're going to buy one of the 305 calls. And this trade structure, again, it costs $36 to put on, but it has a reward of $464. And so you have a massive reward, a small risk. And on top of that, I'm going to show you guys how you can actually make money from the passage of time by putting on such a trade. So there are 3 legs to this trade. There's an option you bought, there's an option you sold, and then there's an option you bought. Now, options have time value to them, right? Because they have an expiration, so they have a certain amount of time value to them. And the option that you bought, the first one, which was a 295 call, it doesn't start decaying in time value until very close to expiration. The 300 call, it decays like this. It starts decaying pretty far away from expiration. And then the 305 call, which is a call that you bought more as a hedge, that decays well before expiration. And so now I'm able to place a spread right here. I'm able to sell 2 of these, and they start decaying right away. I'm able to buy one of these, and they hold their value. I'm also able to buy one of these as a hedge, and it's already lost all of its value. So it all holds all the value that it really has left, or loses very little value since it's already lost a vast majority of its value. That is how you can actually make money from the passage of time using an options trade like this, and have a massively good risk to reward ratio. Okay, so that's a butterfly spread right there. Again, risking a real small amount, making a lot, and making money from the passage of time. On top of that, because it's multi-legged, it's so easy to rearrange. So if you want to take that bullish trade, that slightly bullish trade right there, and you want to convert it into a bearish trade because the market started to come down and you think it's actually going to crash, you can very quickly take that call spread that you bought, get rid of it, roll down the call spread that you sold, go ahead and buy a put spread, and boom, you've turned it into a bearish trade right there. It's really easy to adjust those sorts of trades right there. The next trade we're going to take a look at is on Visa. So on Visa, we did two different strategies and we combined them together. We sold a put spread. The problem with selling put spreads, though, is that they are high probability trades, but you usually don't make a lot of money from them. And then we use that to buy a calendar spread. Now, calendar spreads, they're good trades, but calendar spreads are very binary trades. You either win or you lose. And if you start to lose on a trade, you just get rid of the trade and get rid of it at a loss. And that's why I generally don't like putting on calendar spreads alone. But you can combine these two and they turn out to be a great strategy. So what we did was that we combined two different strategies, a put spread and a calendar spread, and it initially actually didn't go in our favor. So I thought that Visa would just chop around sideways, and actually Visa broke out bullish, and we had to make an adjustment, but we still ended up making a lot on this trade. So let's hop back onto the computer, and let's actually take a look at what this trade structure is, and when you want to use it, and the example of how we use it on Visa. Go over this trade in Visa. Now, before I go over the trade itself, though, let's go over what a put spread is. And essentially in a put spread, you put this on, and whenever you're selling a put spread, you put this sort of a trade on, usually when the price is above the first strike price. So basically, you're going to be selling a 190 put and buying a 180 put. Pretty simple. And if it goes down, that's when you start losing money. This is your break-even price. And so you usually would place this like at 195 or at 200 or that like 190. And you could just make money from the passage of time, and ultimately you could reuse this to finance the buying of a calendar spread. Now, what is a calendar spread? Calendar spread looks like this. Your max profit point are your strikes, and you basically buy a call option at the 200 strike that expires really far out, and then you sell a call option on that expires closer to expiration at the 200 strike. And when you combine both these together the way we did, to sell a put spread, use the money you get from that to go and finance a calendar spread, this is what it looks like. And that is what the payoff diagram looks like. And that is initially what we did. Now, why did I put this sort of a trade on? Well, there was nice support here at 180, so I didn't think it would go below that. But also, I was worried about my upside. The reason I was worried about the upside, I didn't just want to put a calendar spread on, is because I saw there was a strong resistance, but also because I knew the rest of the market was going up, it could easily break out and it could defeat this resistance level right here, and it could just continue higher, which it eventually did. And so that's why I had placed it in such a manner where we could still break even if the price went higher. But then what did we do? Well, you can easily make an adjustment to this. So then, afterwards, we did profit management by rolling up strikes. So then we rolled up our strikes, and then eventually we turned this into a diagonal spread. We had to pay a little bit to turn it into a diagonal spread, but then we also got paid to roll up the put spread. So if essentially, it just put us in a position that was costless. It didn't cost us anything to do that, and then eventually we took it off for a 50% profit, and this was, on entry, 5% of our portfolio that was being risked. And it's a really nice trade to put on. It's a bit of a creative trade. This way, if you think that something is going to stay range-bound, but you're worried about the upside risk, which in this market you should be worried about the upside risk, then this is a great trade to put on. And this works more on your laggard sectors, like your financials, your Russell 2000, ones like Visa, MasterCard to a certain extent, American Express. It would have worked really well on those names. Okay, so those two trade structures that we discussed, they work well for leading and lagging sectors. The QQQ trade works great for leading sectors, and the Visa trade works well for lagging sectors. Now, as I said, I am here to sell you guys on something, so don't click off this video. Just give me 1 minute to give you guys a nice value proposition. In 2020, we've had more retail traders join than ever before. And the 90-90-90 rule says that 90% of retail traders lose 90% of their capital within 90 days. And what I recommend to most retail traders is that they get the proper education. Here at Alpha Action, we send out trade alerts, and we tell you why we actually put out those trade alerts by adding an audio message out to each and every trade alert. We have weekly videos answering all your questions inside those weekly videos, and also taking ticker requests. And in those weekly videos, we discuss institutional, professional style
portfolio construction and what we expect going on in the markets. And so it's a fully comprehensive advisory, and it's $49 a month for a monthly plan, or for an annual plan, it is $499 a month. Again, guys, this is 500 times less capital than what the average retail trader will lose. So you get all that opportunity cost back. You can actually end up making money. We were up 11.5% last month. That's almost a 300% annualized return. And on top of that, you put yourself in a situation where you save all that extra capital and time that you would have lost. So again, think about it, guys. Link in the description below, pinned inside the comment section. And also on top of that, for the next week and a half, we are giving the free trial. Just click link in the description below, pinned inside the comment section. Click on the link, and then afterwards, in the upper right-hand corner, it says subscribe. You simply subscribe, put in your email, and you get an email notification of everything we send out. Thanks for watching, everybody. Have a great day. Happy trading. Stay safe. Stay profitable. We'll see you next time.